Welcome, everyone. I just want to wait a few minutes for everybody to get online here and join, and then we'll get started on our presentation. So bear with us for a moment. Hope everyone who's joined us so far is having a good morning, and thank you so much for joining us. Get your coffee and we'll get started in a moment. I'm sure you're all going to enjoy this presentation, especially with Halloween so close. It can't be any scarier than that. Okay, oh. I think some people might be having a little bit of problem getting on the site, but another moment or so, and they should all be there. Okay, I'm sure there's a few more people who will kind of join us in a moment, but we'll get started. So I want to welcome everybody. Good morning, and I want to just tell you, my name is Jeff Greenfeld. I'm with Greenfeld Financial Management here in Ladner, IA Private Wealth, and I want to thank you again for joining us this morning for this webinar on death and taxes. Here's where we're going to learn all about taxation on death and about the important estate planning considerations. My guest today is Sarah Hillier. She's the Senior Director of Trust Solutions from ClearEstate. And here at Greenfeld Financial, we've partnered with this knowledgeable estate professionals at ClearEstate in order to assist all of our clients with some straightforward, transparent estate planning and settlement solutions using state-of-the-art technology. So before we begin today, though, I do want to do a little bit of housekeeping, and I want to let everyone know that everyone attending will be muted for the duration of the presentation. If you've got any comments or questions, you can enter them into the Q&A or the chat box on the screen. You'll find those buttons down below. We'll answer all these during the Q&A questions session at the end of the webinar. Also, Karen will be entering our contact information in the chat box that you'll see. So you can always send us an email with any questions you might have, another way to do it. And lastly, this webinar is being recorded. So the link to this recording will be emailed to everyone who registered. And so you'll be able to do some follow-up with that. You can also choose to display the captioning by toggling on the closed caption button at the bottom of the screen. Now I'm going to hand the webinar over to our guest speaker, Sarah. And Sarah, over to you.
Thanks very much, Jeff. I appreciate the warm intro and happy to be here with you guys today to chat about very exciting topic, death and taxes. Just a quick agenda here. Of course, some of the topics we're going to cover today are really probate tax is always a big one and important for us to kind of understand what that's about. The deemed disposition of tax on death and kind of how that impacts things. The tax filings that actually occur after you pass away, and then we'll dive into the specifics of taxation by asset type. So hope everyone is ready for it's a bit technical, but like I always highlight when I cover these topics, my goal is to make the technical topics approachable and offer practical guidance for you. So without further ado, the learning outcomes that our goal for you today is to kind of understand taxation on death, what's going to actually happen in terms of that with your assets, and where you can get help to actually plan for this and prepare for it. So the first thing we're going to touch on is probate tax. Now, probate tax is often kind of misunderstood in terms of how and when it applies and what it's actually for. So I thought I would break down an explanation for you here. What probate actually is a court process, a legal process where the will, if there is one, is and the estate representative, so in some cases the executor, if they're appointed in the will, or someone who puts their hand up to say they want to do it if there is no will, the court process where those two things are legally validated or verified. Now, when probate is needed is a question of what are the assets that are falling into the estate, and whether or not the estate representative or the executor will require probate in order to go to the third parties that hold the assets, like the financial institution, and actually present probate to them. So it's basically needed when third parties require proof of the executor's authority. Okay. Now, depending on what type of asset it is, typically you'll always require it for real estate, and with exceptions based on the ownership of the real estate, but generally speaking, and where there's financial assets, investment accounts, bank accounts, particularly if they're over a certain threshold. But it's always the third party's right to demand probate before they'll accept instructions from the executor. Now, what's important when we're talking about planning for probate, and why you hear probably a lot about probate, avoidance or attempting to, create efficiencies or savings, is because most jurisdictions, including BC, impose some type of probate fee or tax. Sometimes it's called a fee, sometimes it's called a tax, which is entirely separate from income tax. So that's important to understand. Now, the specific assets that are typically subject to probate are essentially anything that actually is falling into the estate to be dealt with under the will. So that typically includes real estate, where it's held in your individual name or as tenants in common. So where you own, let's say 30% of a property and other people own, the 70%. You are able to deduct encumbrances like mortgages when you're applying for probate, but that is the only type of liability you're allowed to deduct. And then all these other assets we've listed here, where you have an individual bank account in your individual name. I put joint for convenience because that's where sometimes a parent might joint an account with an adult child because their adult child is going to help them with paying bills and things like that. This is depending on the documentation that surrounds that type of an account. This can be considered a joint for convenience account, in which case the entire account is technically still owned by the parent and therefore forms part of the estate and therefore can be subject to probate fees. If you have individual non-registered investment accounts, if you have vehicles, personal effects, business interests, there are some exceptions to those categories. And then any registered plans or pension plans or life insurance where there either is no named beneficiary or you've actually named your estate as the beneficiary. These generally fall into your estate and then therefore they're subject to probate fees. And with life insurance, the death benefit would actually be potentially subject to probate fees in that case. Loans and promissory notes that are owed to you can also be subject to probate. What's typically not subject to probate is when you hold real estate as joint tenants, so joint with right of survivorship, or you have bank accounts that are held in the same way with a joint with right of survivorship. So most commonly we see this between spouses. And then also where there's investment accounts held joint with right of survivorship. Again, a lot of times you see this with spouses, of course. Any assets that are eligible under a secondary will. So in some jurisdictions, including BC, you can actually do a secondary will for assets that are not going to require probate. And I mentioned a few of them specifically here. If there's a death benefit from Canadian Pension Plan, that's not generally subject to probate. The first dealings exemption is more specific to Ontario, so I'll skip that one. Life insurance and pensions that have named beneficiaries, so it's not going through the estate, it's going outside of the estate. That's not typically subject to probate. Registered pension plans where you've named a beneficiary, an individual or an organization, to receive that account when you pass away. Those won't be subject to probate, or where it's going to your spouse as well, individuals that are named. And also in some cases where assets are held in an inter vivos trust, which is a type of trust, sometimes referred to as a living trust, that you would establish during your lifetime, in scenarios where that might make sense for you. Now, how probate tax is actually calculated, and I've put up here, should be, there you go. So you can see here the specific probate tax in British Columbia and how exactly that's calculated. It's not the highest, but it is one of the highest in terms of the percentage, the tier that you end up actually paying, 1.4%, where the estate is valued over 50,000. It's based on the date of death value of the estate assets. And like I said, only real estate encumbrances can be deducted from it. And this needs to be paid at the time that your executor applies for probate. So it's very important that this is kind of understood as part of your estate planning process so that you can adequately plan for how this is going to be paid when the time comes. There's a bit of a catch-22 where the executor may need access to the assets of the estate to pay for probate fees, but meanwhile, they need probate in order to actually have access to the estate assets. So sometimes there's a bit of a, it's a bit tricky to actually navigate the process. Now, okay, so now that we understand the basis of probate fees, let's talk about income tax separately. So income tax, when you pass away, there's a deemed disposition of all of your assets, basically. So it's as if you sold everything you own immediately prior to your death. In cases where the assets you have increased in value since you received them or purchased them, then this is potentially a capital gain. And capital gains tax may be applicable as a result of this deemed disposition on death, right? I will mention, I'll talk more specifically about it, but there are certain deductions potentially. I won't go into too much details, but you know, there are potential things to offset income, of course, as there are usually for you when you prepare your tax returns. However, generally speaking, capital gains tax may apply for a lot of people when they pass away because they have assets that have increased in value. Now, there is an exception where assets are going to a surviving spouse where the original cost base can be rolled over. So essentially, they just inherit the original purchase price of the asset, and that is done through jointly electing with the executor and the surviving spouse in order to be able to do that. It's not necessarily automatic. It has to be kind of talked about or sorted out when the time comes. And not everybody actually does elect to do that. There may be reasons why you might not want to do that. And I won't get too technical on that, but all to say that your executor needs to kind of think about those things and potentially strategize around those things. So in terms of the actual tax returns that are involved when you pass away, there's a few. The first one is your that is still due potentially is any prior year tax returns that haven't already been filed, where you would declare all of the usual taxable events that you would typically declare on your tax returns. So those would be filed as usual. And it's important to also understand that if there are prior year outstanding tax returns, then it becomes the executor's responsibility to address those returns and the estate any resulting tax liabilities associated with those prior year returns. In terms of in your year of death, we have your terminal T1 tax return. So essentially your last tax return, your last personal tax return, where it's going to capture the period of January 1st until your date of death in your year of death. And it would include all of the usual taxable events. If you're working, you would be reporting that income on this return. If you have investment income that you've received, all of those things that would normally be on your tax return will be on this tax return. Plus, it will also incorporate the deemed disposition on death of all your assets. So if that does trigger capital gains, regardless of what actually happens with the assets, then this is the return it's reported on, and this is the tax liability associated has to be paid from your estate. There are a few optional returns that could also be filed potentially if it's advantageous to do so, depending on the types of income to be reported. So certain types of income you could spread out onto additional optional returns in order to achieve a lesser overall tax burden, but that just depends on what types of incomes there are to be reported. Now, the final one, which could be one return or could be more than one return, depending on how things transpire in your estate and even the timing of your passing. But from the period of your date of death to the 12-month period afterwards, or could be less than 12 months, but up to 12-month period afterwards, and every additional 12-month period after that, there's also an estate return that has to be filed for as long as the estate is still being administered and not yet distributed. There'll be a T3 tax return, which is to report any income and interest or capital gains that are received or realized after the date of death and before it's distributed to the beneficiaries. All of this is the responsibility of your executor, and all of these returns must be assessed as filed before CRA will actually issue a clearance certificate. A clearance certificate is what your executor needs in order to formally say that they've done everything that they're supposed to do, and CRA is good with all of the information and all of the records that have been submitted, and that it's their sort of protection. Now, if new information gets uncovered, even years into the future, the executor actually still is responsible for that. But the clearance certificate clears them in terms of what's already been submitted, that everything is okay according to CRA, which is really important for them to have before they distribute everything in the estate. So now we're going to talk about specific assets and the taxation of the specific asset types. So first I'll deal with your principal residence. If you own a property, there is in Canada, of course, a principal residence exemption. I'm sure most of you are familiar with it, but essentially, it's a capital gains exemption for the period of time that, by CRA's definition, you ordinarily occupy a property as your principal residence. It's important to understand you can only have one principal residence at a time per family unit. Family unit as in, spouses and, minor children, or children that are living together with them. And if you pass away and you only owned one property, and it qualifies as your principal residence for the entire time you owned it, then there'll be no resulting tax liability on your passing. Now, often when we see an estate settlement, what's not necessarily understood is that after you pass away, the property no longer qualifies because, of course, sadly, you're now deceased and you're not living in your property. Therefore, there's no principal residence exemption, with the exception of where a beneficiary continues to live in the property. In that case, they could be entitled to it. So if real estate goes up in value after you pass away and before it's either sold or transferred to a beneficiary, then there can be a gain there that is taxable. And that's important to understand because depending on where you live and what the real estate market is like, it could potentially be significant, hard to predict, of course. Now, if the property is held in your sole name or as tenants in common, as I mentioned before, probate fees would also typically apply, at least for the portion that you own. Now, in terms of additional real estate properties like recreational properties or rental income properties, these properties would not have access to the principal residence exemption. Although, you know, I mean, some people may actually treat their cottage as their principal residence. So not to kind of confuse those two things. Any property that you own that you're not treating as your principal residence would potentially have a capital gain associated with it if it's increased in value. In most cases, real estate has. And the only thing you can use against that is receipts for capital improvements you've made to the property. So, you know, following certain criteria, expenditures that you've had to actually improve the property and its value can be used against that. If the property is rented, rental income is going to be taxed as usual. Rental expenses could be used against the income as usual. And again, if the property is held in your sole name or you own a portion of it as tenants in common, probate fees would typically apply. Now, in terms of bank accounts or any loans or promissory notes owing to you, if there's any interest earned, if there's any interest that you're earning or you continue to earn after death, that would still be taxable, either on your personal return or after death, potentially in your estate. If there's bank accounts that are held, like I said earlier, as joint for convenience, these assets will be typically subject to probate fees. If it's truly joint with right of survivorship, and there's an assumption if it's a spouse that it is joint with right of survivorship, but that same assumption doesn't extend to children. So it's important that however you intend is actually documented. These assets would be subject to probate fees if it forms part of your estate. Now, with respect to non-registered investment accounts, any interest, dividends, capital gains earned or realized up to date of death would be taxed as usual. Any unrealized capital gains would potentially be realized due to the deemed disposition on death, unless rolling over. And again, resulting tax liability is payable from your estate. After death, income and growth would be taxable in the estate as well. So there's a theme here, lots of tax. But in terms of some other types of accounts, and there's generally a lot of questions about the kind of tax-free or registered accounts. So I'm going to try to cover these as best I can. With tax-free savings account, income earned up to the date of death is tax-free. They truly are tax-free accounts in that regard. If you name a successor holder, which can only be a spouse, they can actually take over the TFSA essentially when you die and continue to grow it tax-free. That sort of happens automatically if they're the successor holder. If you name any individual or organization as the beneficiary, then they will receive the funds in your TFSA. But any income that's earned after date of death will be taxable in their hands. I will mention that when TFSAs first came out, they didn't have the successor holder option. So I still catch sometimes where spouses are beneficiaries and not successor holders. Successor holders allows for a little bit more simple tax efficiency. It doesn't always make a huge difference when the time comes, but generally it makes more sense to be the successor holder than the beneficiary if you are a spouse. And so I would encourage you, if you have a TFSA, double check that. If you do have a spouse and you have them as your beneficiary, you should double check. Now, if you name your estate, or there's no named beneficiary that actually survives you, then the date of death value of your TFSA will typically be subject to probate fees. And again, income earned after date of death would be taxed in the estate or the beneficiary's hands. Now, in regards to our RSPs, These accounts are really tax deferral vehicles. And if you name your spouse as a beneficiary, they can roll over the funds to their RRSP. And the tax liability will continue to be deferred until the time that it's actually withdrawn from the surviving spouse's RSP or they pass away. If you name any other individual or organization as a beneficiary, they will receive the full amount of the registered plan directly. However, the entire amount will become taxable income, and the resulting tax liability will be reported on the terminal T1 that I mentioned, and it will be payable by your estate. It's important to understand that because when you're planning your estate and the distribution, it's important to kind of understand the cash flow of things and where liabilities are actually going to be paid from. Now, if you name your estate or no named beneficiary survives you, then typically the RSP would also be subject to probate fees as well. And I did want to mention here, because sometimes this happens, if your spouse receives assets from your RSP, it's possible for them to potentially have a rollover period to contribute the funds to their RSP to basically have the same effect as if it went directly. So there's kind of an opportunity to correct that if needed. Now, with respect to registered retirement income funds or RIFs, which are somewhat similar to RSPs, but of course, this is for once you've turned 71, you're no longer making contributions and you have a minimum amount you have to withdraw. Essentially similar to a successor holder, a successor annuitant, they take over your RIF and there's no tax impact to your estate at that time. If you name an individual or organization, they'll receive the full amount directly, and just like with the RRSP, becomes taxable income. Resulting tax liability is payable by your estate. If you name your, same concept here, if you name your estate or there's no named beneficiary, that entire amount becomes taxable income, and the date of death value will also typically be subject to probate fees in that case. Similar exception with the RIF as well to rolling over. Now, in terms of life insurance policies, this is another area where sometimes there's a bit of misconceptions or confusion around things, but generally speaking, death benefits are not subject to income tax. So there would be no scenario where the death benefit would be subject to income tax. However, if it's payable to the estate, it's typically subject to probate fees. And I'll just add a quick note here that depending on how you structure your life insurance or what type of life insurance you have, there are some types of life insurance where there can be tax implications for choosing to do certain things. So for example, if you have a permanent life insurance policy and you decide to surrender it for its cash value, the cash value may be subject to income tax. Important to understand that when you're planning those things. Now, in terms of pensions, government benefits, and things like that, all of those are generally considered taxable income. Now, there are some death benefits that could be exempt up to a certain threshold, but any overpayments that potentially have been made, which happens often because, of course, there's a lag between somebody passing away and institutions being notified of that passing and doing what they need to do from the administrative side of things. So if there's overpayments, those actually need to be repaid from the estate. So it's important that's tracked carefully, of course, by your executor. And if there are survivor pensions involved, then those would be taxable income in the hands of the survivor. Quick note about personal effects. I think people don't often talk about these in terms of taxation, but there is some tax implications to personal effects. Number one is if probate's needed, then technically the value of your personal effects is also considered, a probatable asset. And typically that's not, we're not talking about the purchase price of things. We're talking about the fair market value of things. So a lot of times for household contents, that might not be significant, but for collectibles and things like that, it can very well be significant, and probates typically, fees are typically required on that. Now, if there are personal effects that have appreciated in value and there's a deemed disposition on death, then technically there's also a taxable capital gain associated with that personal property. So generally speaking, this is more for, you know, highly valuable artwork or collectibles or things of that nature. However, I will, a side note here, that in most jurisdictions, you know, they're taking steps to essentially make sure that executors are actually reporting correctly the value of the estate assets. For example, in Ontario, a few years ago, they introduced an estate information return, which is an extra step the executor has to take after probate to basically reconfirm all the values of the assets. And the view on that is that, you know, when audits are being conducted by the probate courts, they have seen, I think, a lot of probate applications where there's a principal residence, sometimes, you know, of significant size with no reported personal effects, which doesn't generally make a lot of sense, because of course, if you own a 3-bedroom home that you say you reside in, it generally will have something in it, right? So different things like that are I think becoming more and more things people need to watch out for. And I'll just cover real quick business interests. You know, this might not be applicable for everybody, but if you do hold private company shares, it's important to understand that the value of those shares will form part of your estate. And unless you've implemented efficient estate planning, like, for example, a dual will strategy, which again is something that can be done in some provinces, including BC, where you can plan around that and have a separate will for your sort of non-probate assets. And private company shares can be included in this category. The date of death value of the shares will be subject to probate fees unless you've implemented some type of planning like that. Often with spouses, there's kind of a double hit here, or for any asset where, you know, you hold it in your individual name and then it passes from one spouse to the next, and then, you know, ultimately to your sort of mutual beneficiaries when the time comes, like your children. In some cases, you've paid probate fees, you know, on the death of the first spouse, and then again on the death of the second spouse, and sometimes on the same assets. Or a portion of the same assets. So this is important kind of planning that you want to try to put into place to avoid that. And something else to note about private company shares is that because the shares are typically created for a nominal value, that usually means that, you know, as you accumulate wealth in your corporation, the shares go up in value, right? And so there could be a significant capital gain due to that deemed disposition on death. And then when you ultimately go to extract the shares or the value from the corporation, there's another layer of tax when you actually go and do that. So this can result in double taxation, and it's something that can be avoided or mitigated with careful planning. However, it's important that, you know, if you're appointing your executor, you're thinking about how they're going to carry out all of these things. Okay, so real quick, I will just cover, you know, a little bit about how ClearEstate actually does things in terms of estate planning for your information. And then we'll move on to Q&A. If there's any questions, happy to address those. So ClearEstate's approach, you know, as Jeff said, we do this all day, every day. We work on estate settlement and we work on estate planning. And we do that using our platform for sort of tech-enabled efficiency while also having, you know, human subject matter experts and folks to support you and guide you through the process. Similar to financial planning process, we approach estate planning by, collecting information into our platform and then kind of going through the key considerations for you based on your circumstances, developing a personalized plan, and then, of course, actually executing that plan by generating the documents that are needed. So, a will, power of attorney documents, all of those things. And then, of course, securely storing everything in our vault for both for the purpose of, you having a clear view of what your plan is, but also so that when that time comes, with a few clicks of a button, your loved ones will have access to the information that they need to carry out your estate settlement, which we know is not an easy process to navigate, and we can be there to support them potentially. Now, unlimited access to the platform on an ongoing basis and kind of regular check-ins to make sure everything still makes good sense for you. That's our approach to the overall estate planning kind of journey. Because we get this question a lot about how we actually also provide fiduciary services. I just wanted to add here that essentially, ClearEstate, what we're trying to do is provide people with a more accessible and affordable option than a traditional trust company or using a lawyer to actually provide these services. And so we are able to offer fiduciary services. So essentially, for folks who either don't have someone in mind to act as their executor, or they don't want to kind of burden their family member with that work because it is, a huge honor, but it's so right? Even liability takes typically hundreds of hours over sometimes to fully get through the process. So we do before that. You can see expensive and that be quite significant, particularly if you haven't considered any planning around those things, potential tax efficiencies and potential ways to make things easier on your family, or at least account for the expenses that are going to be in your estate. It's really important that you get the right help. I would encourage you to seek expert guidance. Of course, like I said, talk to Jeff, consider what efficiencies might be relevant for you, and certainly prepare your family for the inevitable estate settlement that will come one day, hopefully not for a long time. And then always revisit your plan, right? And have a review of your circumstances. Remind yourself of why you have certain things in place, and consider whether that continues to be relevant over time. There's lots of life events that happen that we, need to maybe rethink our estate plan, whether that's, someone close to you passing away, maybe the birth of a new grandchild, etc. Maybe there's a marriage or a divorce. Maybe there's a move from one jurisdiction to another jurisdiction. The rules might be different, or any other kind of significant change with your assets, the ownership structure of your assets. It's really important to review your estate plan and make sure that it still makes good sense for you. Lastly, of course, we do offer free consultations. Talk to Jeff if you'd like to think about doing that further and exploring your own particular estate planning needs. Happy to explore with you. So I think with that, we can, of course, see if there are any questions. I'm happy to address the questions. And I think, let's see, let me see if I can see the, I'm going to stop share and then I can see the Q&A better as well. Okay, perfect. So if you do have questions, please do feel free to actually add questions into the Q&A box at the bottom. And if not, I think Jeff had already collected some questions, and I'm sure we'll be happy to ask me them as well.
Sarah?
Yes.
That's great presentation. Thank you very much. I appreciate that. I'm really glad you were able to show all these um, various financial products, how they're taxed in the estate. Now, if anybody's got any questions or comments, please add them to the Q&A or chat box, and we'll just address them as we go along here. So in the interim, right now, Sarah, I've got a few questions I wanted to ask. I've got here. One is, I'll be an executor of an estate within the next 10 years. And so what can I do to prepare now to deal with that?
Yeah, that's a great question. Super great question. So I would say, there's probably the most important thing that you could do is understand what your responsibilities will be when the time comes. So just learning about what actually is involved in acting as an executor, and kind of getting yourself a little bit comfortable with those kind of concepts. Attending webinars like this is definitely a great thing. And then the number two thing is make sure that you actually know how to access all of the information that you're going to need when the time comes. Everything from, there's some obvious things, right? Like bank accounts, like where are the bank accounts? What are the bank account numbers? Real estate, but there's also like, access to the computer, like, is there a password, right? Like even somebody's phone, like if they use iCloud, are you going to have access to their pictures and things like that, that we don't always think of when we're just dealing and focusing on, financial assets and financial accounts. But of course, those are hugely important things. So I would just say, like, to the extent possible, familiarize yourself with the actual details of what you're going to be dealing with and know where to access it. Maybe most importantly, where is the will? Where is the original will? Is it in a safety deposit box? Where is it? And having quick access to at least a copy of it, but also knowing where the original is located is really important for you to be able to carry out your duties effectively.
I'm assuming mostly to keep the communication lines open between, as an executor, to the person who's put you in their will as the executor or executrix, whichever the case may be. Another question here is what do I have to do if I'm having difficulty finding an executor? What can I do?
Yeah, this is a great question. And we do get asked this question quite a bit. So I talked a little bit already about how ClearEstate can potentially help in that situation. And again, encourage you to chat with Jeff and subsequently perhaps chat with us. But there's a few options that you have in terms of appointing a professional or considering a professional. So of course, if you have a loved one that you want them to do it, number one is like, make sure that you actually talk to them about it and they actually agree to do it, because surprisingly, lots of times people actually don't know their executor until after the person's passed away. So make sure that they get it, they get what's going to be involved, and they actually agree. If you don't have someone like that, and I can tell you, as people find out more and more what's involved, that it's less likely that they want to do it. Truth be told, right? Myself included, to be personally appointed as an executor. So if you don't have someone like that, you can seek out a professional. There's a few, different types of professionals that might be appropriate. Traditionally, trust companies, right? They would charge like a tiered fee schedule based on the value of the assets. It typically starts around 4%. The challenge with that is a lot of times the access is limited until you reach a certain asset threshold. So it's out of reach for a lot of families. If you could also consider a lawyer. A lawyer may do it. Generally speaking, lawyers would typically charge the full amount that is kind of the guideline of the court, and that's 5% of the value of the estate. They would typically often also charge kind of the professional fees potentially for preparing a probate application if they did that as well. Sometimes there's accountants that might do it. Sometimes even depending different types of consultants. ClearEstate, our approach is to do as much of the pre-work as possible with you. So really have a complete picture and understanding of your assets, and use our platform to do a lot of the work efficiently, because our platform actually prepares probate applications and it generates the forms that are needed. So our rate is 1% of the value of the estate, which is obviously a bit different than traditional service providers. If there's absolutely no one and assets need to be dealt with, it's kind of up to whoever is inheriting those assets to come up with some plan to address it. And most provinces have some type of public, guardian and trustee, including BC, who would ultimately be responsible if no one is stepping forward. Now, that department definitely does not have a lot of resources, so it best if you actually have a plan for who's going to act.
Kind of leads into the last thing I have here is what's the alternatives when you don't have an executor for the last survivor's will? And you just mentioned that ClearEstate has the option, of course, lawyers and etc.
Yeah.
You want to address that briefly?
Yeah, sure. So I think I've kind of outlined what the options are with respect to that. I guess the only other thing that I'll add is what sometimes is possible and makes sense for certain people is to actually consider a professional as a co-executor with a family member. And that way you're alleviating the family member of a lot of the burden, right, of the actual details of the work. And you're essentially ensuring that there's professional expertise and guidance involved, but allowing them to be involved in some of the decision making. So that's a route that some folks will choose if they still want their family to be involved in the decision making.
That's that's a really good option, actually, because you want to have somebody who's professional, who knows how to handle things, but you want somebody who's in the family that can kind of give guidance to the person who's going to handle everything professionally and not put the burden on them to be able to deal with all these things. I know it's quite a burden to be an executor. Um, Unfortunately, when you have to do it, you have to do it. But it's nice to have the guidance, know that you've got the guidance there. There's another, is it better to give the beneficiaries their inheritance prior to death, or to put it in as part of the will for them? What's your thoughts on that?
Yeah, that is a great question, and one that we do get often as well. I'll say that there's no right or wrong answer to this one, but what I will say is that while it's important to understand, potential savings and strategies you could implement, and certainly whenever I talk about probate fees, then this question comes up, well, why don't I just give everything away? Then I don't have to pay those probate fees. And while that is true, I always caution people to, life is very unpredictable and you never know. Relationships can be unpredictable as well. And what you don't want to do is have a situation where you've given away assets that you actually need to use for your benefit during your lifetime. And I know I've heard firsthand from families saying, no problem, I'll make sure they're well taken care of, if they ever need that asset back, right? But then you're creating a odd scenario of kind of requiring someone to have a moral obligation that does not align with the legal obligation. And I always caution that, you know, better safe than sorry. Make sure your assets are protected for you and your benefit during your lifetime. You know, you never know, something could happen to you, you become incapacitated, or you know, it's amazing how long we're living these days with the advancements in, you know, medical science and technology, but that also comes with advanced age diseases that, you know, may eat into funds that you expect to be there at the end of the day. So I think it's important to understand the risks. You can create some savings in your estate, but you're also giving away your asset, and you can't legally take it back once you've given it away.
Okay. I'm just looking to see if there's any other questions I see here in the chat box or the Q&A. I see you in a Q&A. Okay. This one here is, can you decline being an executor? Will you need to follow through with the duty legally if someone names you as an executor in their will and they already have passed away, considering they have not informed you ahead of time?
Yeah. I love this question. This is a great question. You cannot be forced to act as an executor. So the only exception to that might be a professional, but as a lay person, no one can force you to act as an executor. And in fact, this is why it's so important that you actually talk to the person you want to name as executor about it, because of course they can actually decline when the time comes, right? And in fact, it's something that we've seen at ClearEstate. We've seen this occur on many occasions, where what ends up happening often is the person who's appointed as executor finds out after the person has passed away, and then they attempt to go about, you know, dealing with it. They realize quickly that it's much more than they are willing or have the time or the energy to participate in, and in which case they essentially renounce or resign their appointment. And in that case, if there's an alternate in your will, then you know, there'd be a person next in line potentially. But again, if you didn't tell them, then it might be just the same story. So it's important, really, really important, that you actually talk to the folks you want appointed and make sure that they agree to it. And if it's you and you're in those shoes, you do not have to take that role on. And what I'll caution is that it's important that you do not undertake any activities which might be construed as you accepting the role if you're in that position. So don't start to act. Like once you start to act, then they could say, okay, no, it seems like you've already accepted the responsibility. So you don't want that to happen.
Perfect. Thank you. Really appreciate that. So we're getting on in time here. It's about getting on to about 7 minutes to the hour.
Sure. Jeff, I see one more question in the Q&A.
Another question. Oh, okay, great. What's the time limit to entirely close the estate, or is it once the clearance certificate has been issued?
Yeah. This is a great question as well. So technically, there's no time limit to close an estate. The executor is expected to to take steps to settle the estate in a timely manner. But there's no official time limit, because there may be missing information, there may be all kinds of things that happen, or depending on the assets and the complexity of the assets, there's no set time that it's supposed to take. However, generally speaking, an estate is considered closed once you've distributed all of the assets as per the instructions in the will and applicable legislation, and you've prepared and filed all the tax returns. Those tax returns have been assessed as filed, and you've received that clearance certificate from CRA. That's generally, and this is why typically it takes 16 to 18, maybe sometimes longer, 24 months to fully close an estate, because the end part is typically kind of a waiting game with CRA and getting the notice of assessments back, and then filing and getting the certificate.
I have a lawyer that I know is dealing with one of my clients' estates, and it's now gone into over just 2 years, and they still haven't settled and it was not a difficult one, but there were issues with the banks and stuff like that. So it's taken a little bit longer
Yeah.
than the norm, I would think.
Yeah.
So,
One potential timeline limitation that I will mention just real quick is that when there's assets in an estate and you're filing that T3 tax return, the one for interest and income after date of death, there's a 3-year period where the estate has access to what we call the graduated rate estate, which basically means that the income that's taxed in the estate, providing the executor takes follows the parameters that they need to follow, it can be taxed essentially at its own marginal tax rates. Beyond that 3-year period, it's automatically taxed at the highest marginal tax rate. So something that executors do need to be aware of and plan around, and hopefully the estate settlement is complete within that time frame.
just, one question I just want to ask you in regards to the CPP and the taxation on that. Someone passes away at the end of a year, let's say in November, December, and the CPP death benefit that's paid by the government is paid to the estate in the following year. And that's the only thing available. That's going to be final. So instead of having to do a T3, can that be taxed in the hands of the person receiving it?
Yeah, if that's the only thing. I don't know. I don't know the answer to that. I
Okay.
would have to find out.
Okay. Just thought I'd bring it
Yeah,
to
it's a
attention.
great question.
Okay. Well, I know I'm not sure. I'm looking to see if there's any other questions that we have in here. I don't see any other questions, nothing in the chat box, nothing in the Q&A. So if there's no further questions, Sarah, I want to thank you very much for this presentation on death and taxes today. And thank you all for coming and joining us today. I really appreciate it. Hope you all enjoyed it. If you'd like to learn how the estate planning conversation, or how to have or start an estate planning conversation with your family, Karen has also posted a link to our blog post that I wrote on that exact topic. It's called Boomers Talk Wealth Transfer with Your Kids. And if you'd like more information, or you'd like to set up a meeting to discuss your personal estate needs, our contact information is also on the screen. Or you can contact our office and we'll get you in touch with the ClearEstate people. Karen has posted all these links in the chat box, I believe. And if there's no other questions, and I don't think there is, so I want to thank you all again. Sarah, thanks again, and enjoy the rest of the day.
My pleasure. Bye, everyone.
Take care. Bye for now.